If you were handed $1 million today and told to invest it, what would you do? You would obviously want the highest return possible to make your money worth even more. But how isn't $1 million enough? Do you really have to invest it and risk it? The answer is, you should always invest your money. Just look at today's inflation rates. $1 million a few months ago isn't worth nearly as much as today. The value of the dollar shrinks. And if you do not invest your money, you will have much less buying power than you assume you would have when you had $1 million in your hand. When you think about investing $1 million, you have a few questions to ask yourself. What are your goals? Think about, what are you trying to turn your $1 million into? And what are you trying to achieve? Is there a certain dollar amount you need? Or a specific goal you're trying to reach? Are you investing for retirement and have $1 amount in mind? What is your risk tolerance? Your risk tolerance greatly affects your investing decisions. The more risk you can take, the higher the rewards you can earn. But again, there are no guarantees. It's always a good idea to diversify with aggressive and conservative investments to reduce the risk of loss. What is your timeline? As you set up your portfolio and invest $1 million, you should have a timeline in mind. Saving for retirement that is 20 years away? Or are you saving for something more immediate? The longer the timeline is, the riskier the investments you can make. Now that you know the importance of investing $1 million to help it keep its worth and make it grow, here are the top 7 ways to invest it. But before we do that, this is not financial advice. And everything that's said in this video is for educational and entertainment purposes. Number 1. Franchising. Franchising is a way to become an entrepreneur with already established business. If you buy into a franchise that is popular in your area, or even up and coming in your area, you can build your target audience and compound your $1 million investment. When you buy a franchise, you buy the rights to the business's name, product, services, images, and all marketing material. Depending on the franchise you invest in, the franchisor may have more say in the business than you would like. So make sure you do your research and know the role of the franchisor is play in your business. Even though you're buying a cookie-cutter business though, you will still have your work cut out for you running an optimal business. Getting the customer base and growing the business is all on your shoulders. You buy the rights to the business and then handle the rest so that you can make your investment grow. Number 2. Rental properties. Investing money in rental properties is a great way to earn passive income, aka make your money work for you. Depending on where you invest, you may even be able to hire a property management company. So all you have to do is invest the money and sit back to collect your monthly rental income. You can invest in many types of rental properties, including single-family homes, multifamily homes, apartment buildings, condo buildings, and commercial real estate such as office buildings, retail centers, or medical offices. When you invest in rental properties, you are the landlord unless you outsource the job to a property management company. If you do this, the property management company's fees come out of your rent. But if there is enough room in your profits to afford it, you can have truly passive income. Real estate appreciates an average of 3.8% per year. Although the past couple of years has seen much faster rates of appreciation, the capital appreciation in addition to the cash flow you could earn from rental income. Plus, you may be able to write off many of your expenses you incur managing the properties because the IRS views running rental properties as a business. Number 3. Startup. If you would rather start your own business versus jumping on someone else's idea with a franchise, you could invest your $1 million in a startup business. But before we do your market research. Make sure there is a need for the product or service you plan to offer. Should also see what your competition will be if other companies already had the same idea. Do you see a void that you could fill? $1 million is a lot of money and enough to get your startup off the ground. But if it turns out to be successful, then you will definitely need extra financing. That's why create a business plan to get financing from a bank. If and when you hear that, but also to give yourself a map to see how this will play out. Keep in mind that you don't necessarily have to start your own startup. There are millions of startups with the unique ideas. Investing in them at early stage could turn out to be huge in the future. But you need to be very careful since 9 out of 10 startups fail. But usually when one of them succeeds, it makes up for all of the losses. Number 4, ETF. If you're looking for a lower risk investment than stocks, you can invest your money in ETFs. One fund holds multiple investments, so your money is already diversified. Rather than investing in just one company, you can invest in multiple ETFs, spreading your money throughout many different sectors and diversifying your investment even farther. If you want to invest in real estate, but don't want the burden of actual owning the physical real estate, you could invest in real estate ETFs. This immediately diversifies your funds across multiple properties, without the need to manage the properties yourself. Your investments won't grow as fast as some of the tech stocks, but they will be stable. Number 5, tech stocks. Tech stocks are always a good bet, and when you have the money to invest in them and take advantage. Technology stocks look so expensive at the onset because of their higher share price, like Amazon that cost over $2,000 per stock. But the sector itself remains extremely profitable even throughout economic downturns. But it also could be risky and fall dramatically like it did recently. Technology stocks are also highly liquid should you bail out. Higher liquidity means you can sell your investments at any time. While there is never a guarantee you will walk away with a profit, knowing that you can liquidate your investments quickly can provide the reassurance you need to part with your money, allowing it to grow even farther. Number 6, dividend stocks. Dividend stocks are the classic. Theoretically, there are no guaranteed dividend. Stocks will always pay dividends. But some stocks have been paying dividends for so long that there is very little chance that they will risk disappointing their investors. The key to growing your wealth through this strategy is to reinvest back the cash flow you receive from dividends. Dividend stocks do have a higher risk, so it's important to gauge the risk you're taking and upset them with more conservative investments to companies that perform well, are able to share their profits with shareholders, giving you regular cash flow. Number 7, diversified. The key to success with any investment is to diversify. Putting all your money into one investment is risky and could result in you walking away with a lot less than $1 million instead, for the greatest results. Diversify your investments. Put money in aggressive dividend stocks as well as less aggressive value stocks. Keep some money for bonds from almost guaranteed return, but then take risks with investments like crypto. Every $1 million investment portfolio should also include some type of real estate. If you're adventurous and want to be a landlord, invest in physical real estate and enjoy the cash flow. If you would rather have something more passive, invest in real estate ETFs or real estate crowdfunding. Just don't put all of your eggs into one basket with this investment. As the last couple of years have shown us, any company can fall apart into the blink of an eye, which means no dividends for dividend shareholders, but it's a nice reward when the profits are there. Investing $1 million is the best thing you can do for your money. Don't let it sit even a high-yield savings account or CD. It won't grow nearly as much as you need it, and it definitely wants to keep the pace with inflation. Thanks for watching, and I will see you in the next one.